Let's start with the one that you see a little mini reflation kind of jump here in the near future. Why don't you define when you say mini, and why do you feel that?
Yeah, so the reason I say mini is because, going back to, early part of November of last year, we were making the call, and this is, my hedge I see saying, hey, look, this is going to be the deepest quad two move ever. The deepest quad two move ever is going to perpetuate the deepest quad two kind of asset market dispersion. You're going to see the worst sell off in bonds ever. You're going to see the highest outperformance of cyclicals ever. You're going to see things like Bitcoin go to 100,000. We were off by 35,000 on that call. Still got some time, I think. But anyway, I don't think that's the case. We don't have the economic setup, the backdrop rather, in terms of the deltas that we're going to observe in growth and inflation on a go-forward basis to perpetuate those kinds of asset moves. However, if you look at slides 16 and 17 with respect to what we're starting to see develop, high beta, low beta ratio looks like it wants to break out to bullish. Same with the small cap, mega cap ratio. On slide 17, you look at value to growth. That certainly looks like it wants to break out. And then lastly, slide 18, I confuse way too many people with these charts, and that's my apologies. I need to find a way to communicate better, and I'm working on it. But the chart on the left on slide 18 just shows the volatility risk premium at, in terms of how we calculate it, 30-day forward at the money put implied vol relative to our rough estimate of the volatility surface relative to where realized volatility is trending on the x-axis. And consistently we've been climbing a wall of worry, and that's really it's increasingly become that we're crowding into shorts, not we, but investor consensus. And so the market is starting to get to a place where it's really ripe for a short squeeze. Now, it's not quite there yet. I would argue we need to get through the October 15th OPEX catalyst before we're fully there. But the most important chart on this slide right now is relates to the mini reflation trade. And again, we're on slide 18, is the dispersion analysis on the right. The dispersion analysis on the right, you got 70, 80% of the upper quintile constituents are cyclical. And this is a very marked shift from where we've been really throughout the summer, whereby 70, 80, 90% of those upper quintile constituents were defensives. And what I mean by quintiles, there's 50 U.S. equity sectors and style factors represented in this month-on-month Sharpe ratio dispersion analysis. So we're looking at the upper quintile versus the lower quintile and seeing what's in it. And that's a big shift from what's just changed. This is kind of the shift we saw going back to October of last year. You look at late October, market was very weak. We were in the second of a 8+% correction, in back-to-back months. But you saw that was the first time for a while that we saw cyclicals really start to lead, and I think that's sort of the similar setup that we have today.
Darius, you've been talking about cyclical leadership. What do you think's driving that?
Yeah, so I mean, clearly the Delta had an impact on growth. It's our view that as the rest of the U.S. and global economies really start to move past the peak impact of the Delta variant from an economic perspective, that growth is set up to bounce again, particularly as we start Q4 here. So I think we're going to start to see some better leading survey data for the month of October, likely in the month of November. That should be followed by better hard data on the lag. But to me, I think the real big setup is the liquidity factor. And this is something like, I think with respect to the debt ceiling and all this other stuff that we, kind of have to wade our way through over the next few weeks, people are forgetting the liquidity factor has not really changed that much. You just look at slide 89 in this deck, cash on the sideline is still really high. We're talking about $4.6 trillion. On slide 90, we've seen this movie before with respect to investors crowding in on the short side in terms of overpaying for put protection, into the later stages of a bull market rally. And that has historically been very positive in terms of dealer flow, unwinding and perpetuating higher highs. And the real main event, in my opinion, is on slides 91 and 92. 91 shows our estimation of the net liquidity being provided from the Fed and the Treasury, the Fed balance sheet minus the change in the Treasury general account. And, that continues to be through the roof. Tapering is not going to really put an end to that. But I think a lot of investors are concerned about slide 92, which is, once we get past the debt ceiling and we push this big budget resolution package back, the bully that is the U.S. Treasury market in terms of public debt issuance and taking money out of the system is going to come back and come back with a vengeance. It's obviously been kind of nowhere to be found all year. And that increasingly looks like it's not going to be the case. You just watch these discussions with Biden and Senator Sinema, Senator Manchin. We're not going to get $3.5 trillion on this budget resolution. It could be $1.5 trillion. Now, I would argue 2 is probably a nice Goldilocks sweet spot in terms of not being too low for people who are, levered long, Peruvian mining stocks. But, 3.5 trillion is probably too high for people who are levered long digital economy mega cap FANG names. And so you get a reasonably sized number that doesn't spook the market in terms of the forward outlook for Treasury issuance. And then we have additional scope for the blue line on slide 91 to continue higher, albeit at a slower pace.